Maybe you've seen the chart. One stock exploded 88% yesterday, and even more after hours. That stock is, of course, Surf Air Mobility. Why the spike? Because Palantir just doubled its stake, going from 10% to 20% ownership. In the next few minutes, I'll break down why that happened, what it means, what Surf Air actually does, and whether this is still a smart opportunity to invest. Now, if you've looked at the chart, you might have noticed this thing was trading a lot higher not too long ago. How much higher? From its peak, Surf Air is still down about 750%. So yes, the opportunity could still be there. I'll explain their business model, the Palantir partnership, and the price levels I'm watching for potential buy or sell decisions. So what exactly is Surf Air? They operate in regional air mobility. Imagine this. You're in San Carlos, California, just as an example, and you want to fly to nearby cities like San Francisco. You search for options, pick a date, and Surf Air gives you regional flight alternatives. It's essentially an AI-enabled operating system for short-distance air travel, currently using small, propeller-driven aircraft. Over time, this is expected to transition into eVTOLs, electric vertical takeoff and landing aircraft, which could massively improve profitability. The tech backbone of this, Palantir's Foundry platform, possibly AIP as well. And here's the kicker. Surf Air doesn't pay Palantir in cash. Instead, they pay in shares. Actually a barter deal, reducing Palantir's risk while leveraging their high-margin software. Why does this matter? For Palantir, it's a low-cost bet with potential upside. The cost of deploying Foundry is marginal. Palantir keeps 80% plus gross margins on software. So instead of spending millions to buy shares, they provide services and take equity. Pretty smart. Now let's look at Surf Air's fundamentals. Q1 revenue, $23.5 million, top of the expected range. Net loss, $18.5 million, down from the prior quarter. 2024 revenue guidance, $100 million goal, achieve profitability by year end. If they can hit that goal, this becomes a much lower risk business, moving away from a cash-burning startup and toward a potentially sustainable company. So, what's happening with the stock? On the day of the spike, Surf Air's volume hit 79 million shares, and that's just retail and institutional money, because Palantir didn't buy these shares on the open market. They were granted directly, so that volume, pure market action, even more bullish. The stock broke above both its 50-day and 150-day moving averages, a very strong technical signal. But here's where I want you to be careful. Is it too late to buy? I tend not to chase stocks that are already up 100%. That's something I've learned from my mentors. Don't trade out of FOMO. There are thousands of other opportunities. This might keep running, but if you feel like you must enter, consider a very small position, e.g. 0.5% to 1% of your portfolio. Set a stop loss, perhaps just below the 150-day MA, though keep in mind this could still drop 20-30% in a volatile pullback. Or just play it safer. With Palantir itself just hit another all-time high, 142.90, and it's approaching strong resistance at 143s. You can see on intraday charts that institutions are selling right at that level. If we break past that resistance, the next wave could begin. If not, expect some sideways action for now. A final thought, not every hot stock is worth chasing. Instead of jumping into Surf Air now, I'd rather focus on textbook trades, less hype, more structure. Take Evo, a stock up nearly 300% in just over a month. Nobody's talking about it, yet institutions are clearly trading it because it meets all the right criteria. Want to learn how to spot these opportunities? Join me live this Saturday at 10 a.m. New York time at felixfriends.org JOXT webinar. It's completely free. I'll teach you a rules-based framework to find these trades and avoid the hype traps. It's the same system used by Wall Street for decades, and anyone can learn it. Let's build your investing compass. Let's get you on the path to financial freedom. See you there. There's been a growing trend lately among giant tech companies. Some have grown so massive that they're now investing directly in the stocks of other companies, especially smaller ones with exciting technologies. These investments often lead to strategic collaborations and of course the potential for gains if those stocks rise in value. I recently showed you how Nvidia has done this, but today's video is all about Amazon. Yes, that Amazon. They've been quietly investing millions and in one case over $1 billion into other companies' stocks. And today we're going to break down Amazon's 5 largest investments, give you my opinion on each, and even rank them from best to worst. Most of these are stocks I haven't covered before, so there's a lot of new ground to explore. Make sure you like and subscribe if you haven't already. Thank you to everyone who supports the channel. I truly appreciate it. Now let's dive right in. We'll go from Amazon's smallest to largest holdings. Number 5, Marvell Technology, MRVL. Amazon holds about $14 million in Marvell, roughly 0.5% of their portfolio. Marvel is a chip designer benefiting from the explosive growth in artificial intelligence, particularly through their AI accelerators and networking chips. Major tech companies like Microsoft, Meta, Google, and even Amazon itself use Marvel's technology. Amazon hired them to design custom Trainium 2 AI accelerators, reportedly achieving 30-40% cost savings over NVIDIA GPUs. It's a compelling story. AI spending is in the hundreds of billions, and Marvel's addressable market keeps growing. Sales and profits are expected to rise significantly. However, competition is heating up, especially from Broadcom, AI chip startups, and even NVIDIA in some areas. If Marvel loses a major contract, it could hit them hard. The stock is down over 40% from recent highs, yet it trades at a PEG ratio below 1, which is about 67% cheaper than the sector average, a rare mix of growth and value. Number 4, Astera Labs, ALAB. Amazon owns over $16 million in Astera Labs, or ALAB, accounting for around 0.7% of its portfolio. ALAB went public in 2023 and has seen major volatility, but it's still up about 34% overall. The company specializes in AI connectivity, helping data centers speed up communication between CPUs, GPUs, and memory, critical for improving AI efficiency. Their client list includes Amazon, NVIDIA, AMD, and Intel. They're now profitable, and both revenue and earnings are projected to grow around 30% annually. However, competition is tough. Even Marvel offers similar solutions and at a cheaper valuation. That's why, while I like ALAB, I'm ranking it just behind Marvel at number 3. Number 3, Vital Farms, VITL. Amazon's stake in Vital Farms is over $46 million, or about 2% of its portfolio. At first glance, this seems odd. Why invest in an egg and butter company when the rest are chip makers? But it makes sense when you remember that Amazon acquired Whole Foods in 2017. Vital Farms products are sold in Whole Foods and other premium grocery chains. Investing in Vital secures a reliable, high-quality supply chain for Whole Foods. Plus, Amazon could help scale the company using its logistics expertise. Some even speculate that Amazon might eventually acquire Vital Farms. The company has shown solid top-line growth, 28% last year, and is now profitable. Still, it's a niche business, and its valuation is 70% above sector averages. Due to limited product diversification and slower growth, I'm ranking this one at number 5, even though I do like what they're doing. Number 2, AMD, Advanced Micro Devices. Amazon invested $84 million in AMD last quarter, its second largest holding at 3.5%. I've always seen AMD as the perfect middle ground, a strong competitor to Intel in CPUs and NVIDIA in GPUs, offering great performance at lower prices. That affordability has helped AMD gain significant market share. For example, while NVIDIA's H100 chips can cost up to 4x more than AMD's MI300X, AMD's chips are still powerful, and the pricing has helped them grab demand in AI data centers. In fact, last year, data center revenue rose 94%, profits jumped 175%, the client segment also doubled bottom line growth. Even after a 40% pullback, AMD's PEG ratio is 28% cheaper than the sector average. I used to own AMD before switching to NVIDIA, but I'm seriously considering jumping back in. For now, it gets my number 1 ranking. So 1, Rivian, Amazon's largest holding by far, with over $1 billion invested, making up 81% of the portfolio. But here's the surprise, I'm not bullish on Rivian. From Amazon's perspective, the investment makes sense. They're building a massive electric delivery fleet supplied by Rivian. But for investors, the picture is less appealing. Rivian's trucks and SUVs are priced at over $8,000, which limits mass market adoption. They plan to launch a more affordable model and have ended Amazon exclusivity, which could open new B2B markets. Still, they're behind competitors in autonomous tech, and their financials remain weak. Despite falling 90% from its IPO, Rivian's price-to-sales ratio is still 250% above the sector. I get why Amazon owns it, but personally, I'm ranking it number 5 due to the risk. Final thoughts. So, here's my ranking recap. AMD, Marvel, Astera Labs, Vital Farms, Rivian. Each of these investments makes sense from Amazon's strategic perspective. They're not just financial bets, they're potential partners, supply chain plays, and tech collaborators. But from a retail investor point of view, I find AMD and Marvel the most compelling. Let me know in the comments, do you own any of these stocks? Do you agree or disagree with my rankings? Thanks for watching. I hope you're all doing well out there, and I'll catch you in the next video. Take care, everyone. Guys, I get it. Buying stocks is one of the most exciting things you can do. And right now, there are 3 on my radar for the month of July. These aren't hype stocks. They're not momentum plays. They're solid, fundamentally strong companies that I believe are mispriced and have the potential to build real long-term wealth. In this video, I'll show you what they are, why I want them, and the exact price points I'm targeting before the end of July. Now, if you're new to the channel, we're going to cover some foundational concepts. But first, a quick note, I currently own all 3 of these stocks. Mo owns none of them. And as always, don't ever buy a stock just because someone on the internet does. Stock number 1, Nike, ticker NKE. Nike is currently trading at $60 per share. The all-time high, $179, that's a 66% drop. Do you remember when we said we'd be interested in Nike under $100? People called us crazy, said it would never happen. Now it's sitting at $60 and the narrative has flipped. Now people are saying the company is dead. Lesson here, news follows stock prices. It's critical to understand this. Sometimes a stock will fall for no reason other than bad sentiment. That's it. Nike is still an $88 billion company. It dominates the sports and apparel world. Last year alone, it generated $5.3 billion in free cash flow and averaged $4.9 billion over the last 5 years. That's solid. It has higher free cash flow than net income and currently trades at 18x free cash flow. Plus, it pays a 2.5% dividend and only uses $2.3 billion of its $5.3 billion cash flow to fund that dividend. Totally sustainable. Another important metric, return on invested capital, ROIC. Nike consistently returns above 10%, indicating it's investing its money wisely, something Warren Buffett looks for in companies with economic moats. Starbucks, Apple, and Nike fall into that category. And get this, Nike currently passes all 8 of our investing pillars. That's rare in today's market. They're growing revenue, net income, and free cash flow. And the valuation is finally becoming reasonable. Analysts expect earnings per share to grow from $2 today to $5.23 over the next few years, which would bring the forward PE to under 12. Revenue is projected to grow from 46B to 57B. Yes, Nike is contracting a bit right now, but this is a long-term, brand-dominant compounder with deep roots in sports culture and global recognition. Stock Adobe has been on a roller coaster. From a $700 high in 2021, it's dipped to as low as $332 and currently sits around $379. This is not a flashy company, it's not Palantir or Tesla, but it's a cash-generating machine with a market cap of $166 billion and an enterprise value of $175 billion, only $9 billion in net debt. Adobe generated $9 billion in free cash flow last year, which means they could pay off all their debt with just 1 year of cash flow, ROIC, over 22% on average the past 5 years and 29% last year. Gross margins, 89%. Profit margins, well, go 30%. That's an elite level business. Yes, some investors are worried AI will replace parts of Adobe's offerings, but right now, analysts expect EPS to grow by over 50% from $21 to $32 in a few years. It's rare to see such high margins, strong returns on capital, and consistent profitability. Stock Southwest Airlines. Southwest is a tougher one. It's an airline, and airlines are notoriously difficult businesses. But here's why I like Southwest. Prior to COVID, they were consistently profitable every single year. They're known for excellent fuel hedging, efficient operations, flying a single airplane model, and strong customer loyalty. Currently, their profit margins are crushed, only 2% last year, but pre-COVID, they were running at 10-15% profit margins. Their current PE is 33, but that's based on depressed earnings. Analysts expect earnings to rise to $4 a share by 2029, and revenue has already hit record highs. If margins recover, this stock could see a serious rebound. You don't need to buy these stocks, but hopefully this gives you a better process for how to think about value, long-term investing, and fundamental analysis. Whether it's Nike, Adobe, or Southwest, every great investment starts with a solid process and discipline. If you want to learn more or be part of a serious investing community, check out Everything Money. It's not for everyone, but if you're committed, now's the time to join. Thanks for watching. See you in the next one.